Hey, I get it. You're tired of being the degenerate gambler that throws his entire life savings into Tesla lotto calls on a Friday. We've all done it. If you haven't experienced it yet, your time will come and more than likely you will. With that being said, I'm sure that's not the reason you guys are here for this video. You're here to learn about supply and demand zones. And I'm going to be showing you guys, I'm going to be teaching you the basics and the fundamentals revolving around supply and demand zone. It's a simple concept. If you stick around to the end of this video, you'll know exactly how to implement it. I'd like to begin the video with just giving a basic definition of what supply zones are. A supply zone is a price area that has been previously determined as a point with strong selling interest. This means the current stock price needs to be under this zone. What are demand zones? A demand zone is a price area below the current stock price that has been previously determined as a point with strong buying interest. So to reiterate on both of these, a supply zone is a point with strong selling interest and a demand zone is a point with strong buying interest. Now the first thing we need to understand about supply and demand zones is it can be done on any time frame. That means daily, hourly, 30-minute, 15-minute, etc. I'm a day trader, so I'm often using the 15-minute. To begin with, to find a demand zone, we're looking for a balanced area or consolidation period. What this essentially means is there are buyers and sellers on both ends and they have agreed on a price range. Now the key to finding a demand zone is finding the spot where price breaks out of this range, which would then establish your demand zone. So we've got exactly that, and I've already kind of drawn it out here on this chart, but I'm going to show you exactly where I kind of saw a consolidation period. So I saw a consolidation period. We're on the 30-minute time frame, and we've got about 4 candlesticks, and we were consolidating between the 697 to 704 price, so about a $7 range that we're consolidating in. And what we understand is institutional traders are the ones that really are moving the market. Retail traders are not the ones that move the market. They're not the ones that can make this quick move in price to the upside. It's just not enough capital that is available. But the great thing about this is we now know that there are buy orders left in this demand zone, this green box, that have been yet to get filled. Institutions are not dumb. They don't want to get filled all the way up here at 723. They know that more than likely there's going to be some profit taking and the price is going to come right back down to this demand zone, and they're going to be able to get filled at the original price that they got filled at either earlier in the day or the day prior. So they're just going to leave those orders are just going to be left at that zone, and they're going to wait until price comes back there, and then that's where they're going to get filled at. So, and we'll see that exactly happens. Price comes right back into our demand zone, and this is where we would play, and this is our strategy. We want to play on this retest of the demand zone. When we see price come right back into this demand zone, that's when we want to enter long for this position. Since we're trading demand, we would want to enter long. So that means we'd enter calls, we'd grab shares, etc. And if you entered off of this, you would see that price made a quick reversal. We saw the sell-off from the morning, and it came to test this demand zone. Then we see, boom, a huge spike in price, right back to almost the level that it got to either in the morning or the day prior. So what we do is we see a shooting star candle. This would be where you take your profits. However, that wasn't the only time that this demand zone was tested. We see that it was tested here. Price moved quickly. That means there's still orders to get filled. Once again, there was another example. Price came into this demand zone, reversed quickly. And finally, another one. Price came into the demand zone and it shot up in volume. Now another thing you can look at when trading demand zones is try to find a hammer candle. So that would be right here, you'd see right here. This isn't a good example of a hammer candle, but we do know that price still came into this demand zone. So if you're trading a demand zone and you see this hammer candle, and you see it close, then you would know that is going to be when you should enter your position. A hammer candle is another example of a common indicator for a reversal in price. So let's take a look at another chart. Looking at another example of a demand zone, we're trying to find a consolidation period once again, so we've got that exactly here. So we're going to click on a rectangle, and this is one thing that I've yet to mention, but many different traders, you'll find out, like to trade demands or draw their demand zones differently. Some traders like to draw it off of the complete consolidation period of the candle. Some like to do it on the base end candle before the actual breakout. It really depends. It depends on your trading style. As you continue to draw these supply and demand zones, you'll see which kind of fit your style better, which you feel more comfortable trading off of. I usually do the consolidation period, but to be completely honest, I change it up a lot as well. It's just kind of something that you got to play it off of the chart, and it just becomes secondhand nature to be able to draw it and understand what levels to draw it off of. So I usually do the consolidation period, but once again, we're kind of looking for price to come right back into this demand zone, and we drew it off of this consolidation period. Price moved quickly, so what that means is there are buy orders left to get filled at this level. Another key way to find a good demand zone is to take a look at what are the actual price levels. Does this seem like it would be a level that buyers would be wanting to buy this particular security at, etc. So once again, we're going to look and we're going to wait for price to come back into this level. Price does that exactly. We come right back into this level and we shoot right back out. So what happens here is these buy orders are getting filled when they weren't able to get filled prior. And this is where you're looking to get long on your position. You look to enter calls, look to grab your shares. Simple as that, really. It really is. It's a really simple concept. Essentially just means it essentially is an area where there are buyers that are going to step in and make a reversal in price. Supply works exactly the same way as demand, just opposite. So you could pretty much flip the chart upside down, it would be the same thing. So what we're looking for is a consolidation period or a balanced period in price. Buyers and sellers can't decide on something. We see that we're on the 30-minute, and we see about 30 minutes consolidate in between the 726 and 720. We then see a quick price movement to the downside. So what this means is there are sell orders left in this price range. So 720 to 726 or to 727 is where people are looking to sell their position. This is where they're looking to take profits. So how we would trade this is when price comes back into this area, we know that there are sell orders still left to get filled, so we know that there's probably going to be a quick sell-off in price because people are going to be looking to take profits once price comes back into the supply zone. And we see exactly that. We see the first initial sell-off from the supply zone that actually established this supply zone. And then we see a retest of the supply zone, and boom, price wicks into it, orders get filled, and there's a sell-off. Price comes into it again. We see a shooting star candle, which is basically the opposite of the hammer stick candle that we discussed earlier in the video. This is where you would look to get short. We see this, and you would look to get into your put positions. And you'll see that it continues to test this supply zone, and every single time it wicks right back out of this supply zone and price falls down. Continues and continues. It shows how this is really a very relevant strategy, and it will always be relevant. And what you would do is if price breaks above this supply, then you would know, okay, I need to cut my position. That didn't work out. But 9 times out of 10, it is a very effective strategy. So let's take a look at another supply chart and then we'll finish up. Taking a look at the SPY, once again, we see a consolidation period with a quick price movement to the downside. So we know that there are sell orders left in this area. This is where people are looking to take profits. So we see our continued sell-off in the morning, and we see price come up to retest this level at a later time. This is where we would either look to get short or look to take our profits as well. Once again, we see a sell-off off of this level and another retest of the supply zone. Again, you would look to get short here, or you'd look to take your profits. And this is a good example of when we now know this supply zone is no longer valid because we see a price movement break to the upside. So this supply zone is no longer a valid supply zone because price broke to the upside. With that being said, I think I've covered everything that you need to know with supply and demand zones, and I hope that you're able to implement this into your trading strategies. If you have any questions, please leave it in the comments below, and yeah, have a great day.